Okay, hello again, and welcome to day 3 of our SIE review. I'm Richard, and good morning, good afternoon, or good evening, depending where you are. We had a request to go over chapter 3 again, so we're a little bit ahead of schedule. So we can go ahead and review that right now. Now, again, as I request, as you always, if you have a question at any time, it's something you just need a little extra something, please feel free. Unmute and ask a question, or type a message in the chat on your control panel. That might take a little bit because I have to look over to see if you typed a message in. Okay, so let's go again, just review again real quickly here about bond features and their bond risks. Okay, so our next one is about call and put features. Now, some bonds are callable bonds. If a bond is callable, that means that the issuer, right, the corporation or the government that sold the bond, has the right to basically cash out investors early prior to the maturity date and just give them their money back, right, to call the bond away from them. Right. Now, why would an issuer, why would a bond issuer want to have a bond with a call feature? Now, they're more likely to want to do that if interest rates have gone down since that bond was issued. That way, they can cash out these old bonds with a higher interest rate and issue new bonds at a lower interest rate and save a whole mess of money right on interest payments, kind of like refinancing a mortgage. Now, typically, though, there's going to be a period of time where they cannot call the bonds away. All right, so that's called call protection. Let me write that out right here on the screen. Okay, that's called call protection. So they say, no, we will not call the bond away from you for a certain period of time, maybe like for the first 5 years or 10 years. So you're safe from that. But after that, they can cash out investors. If they do, they usually have to offer investors something extra, something over and above the $1,000 par value of the bond, right, for the inconvenience of having their bonds cashed out early. So they might pay a call premium. So they might say a bond is callable at 102. Now, 102, what does that mean? Remember, it means that when you see the price on a bond, it's like a shorthand notation for the price, right? It represents its percentage of par value. So the number 102 is a shorthand for 102% of its par value. Now, how much is 102% of its par value of $1,000? You can crunch the numbers in the calculator, but a faster way, just move the decimal point one place to the right. So if it's callable 102, they'll have to pay them $1,020, an extra 20 over and above the par value. Now, from the investor's point of view, is having their bonds called away from them and cashed out early, is that a good thing or a bad thing from the investor's point of view? From the investor's point of view, probably a bad thing. They'll get their money back, but they're going to stop collecting these interest payments that they've been receiving. Now they got their money back, they'll have to invest that money someplace else. And if interest rates have gone down since that bond was issued, then and that's likely what's happened, then they won't be able to get the same interest rate, the same rate of return they did before. So for a bond investor, yeah, a callable bond has a higher risk to it. In fact, they even call it call risk. If there's going to have a higher risk to it, it's got to offer a higher interest rate. So a callable bond will have a higher coupon or a higher interest rate than a non-callable bond, all else being equal. Okay. Now, the bond might have in its trust indenture, which is the contract basically with the investor, they'd have offered different redemption prices, for example. Now, the closer it gets to its actual maturity date, okay, the longer the bond's been out there, so they probably won't offer them quite as much. Here in our example, this bond is callable anywhere starting from 2033 up until its maturity date in 2038, or beyond that anyway. So if they call them away at 2033, the redemption price is 105, right? 105% of par, which is $1,050. If they call them at 2034, they'll give them $1,040, and so on down the line. Now, at 2038 or after, the redemption price is 100, which again means 100% of par value, which of course means $1,000. Okay, so the yield to call, we've talked about the different yields on bonds. Okay, so again, I've used my pen here, my pencil, right, to illustrate in place of the seesaw diagram. I just kind of like to use this because it's both a visual and tactile reference. Okay, so the yield to call is like yield to maturity. Yield to maturity is the rate of return if the bond is held all the way to the maturity date. The yield to call is the return on investment, but assumes that the bond is in fact called away and cashed out at the earliest possible date. What you find is that the yield to call is the most volatile of the yields, right? It goes up and down the most, right? So when the price goes down, the nominal yield here in the center stays the same. The current yield goes up. The yield to maturity, when it's held all the way to the end, goes up even more. The yield to call will go up even more than that. And of course, if the bond is trading at a premium, the price has gone up. The nominal yield stays the same. The current yield goes down because they had to pay a higher price for it. And the yield to maturity goes down even more than that. The yield to call goes down even more than that. Why does it go up and down the most? It's because it speeds up the whole process. Instead of having to wait 10 years to get their money back, maybe they get it back in 5. So since that speeds everything up, the yield to call always ends up being the most volatile yield. Now, like the slide says, you probably will not need to calculate yield to maturity or yield to call. There is a formula, right? And it looks kind of intimidating on paper, but once you break it down and figure out what it's saying, it falls into place. But you probably don't need it. They're much more concerned that you understand the relationship between how changes in price affect the different yields, rather than actually crunching the number itself. You do want to calculate the current yield, though. Okay, so let me throw this out there. Does anyone remember? Who can tell me? How do you calculate the current yield? What's the formula for current yield? Well, I heard a little static, like someone was about to say something.
Is it the annual yield divided by the bond market price?
It's almost. It's the annual income, right? Okay, that's
Income, okay.
right. That's how much money will the bondholder expect to collect every year in interest payments. Now you'll know the annual income when you know the nominal yield, the named interest rate. So you take that, what they get over a year's time, and divide that by the current price or the market price. Perfect. Yes, and then it's expressed as a percentage. Okay, that's a formula you want to know. Okay, Karina says interest of annual divided by market price. Yes, that's a formula you definitely want to know. Okay, the yield to maturity formula starts with the current yield formula, adds some extra steps to it. But like I said, you probably don't really need it. So just as long as you know the relationship. Okay, good. Okay, now again, in a discount bond, the yield to call takes into advantage, like I said, the coupon, plus if you add to it, the difference between what they bought it for and what they get when it matures. Right, okay, and call premium if there is any. So somebody bought the bond, let's say for $950, and let's just assume they get $1,000 if it's called away. The slide here says, what if it's callable at $1,030? Well, okay, you bought it for $950. It gets called away from. Oh, I'm sorry. The slide says if you bought it at $900 and it's called away, you get $1,030 for it. Well, if it gets called away from you, what are you gonna? The investor's gonna get a check for $1,030, which is $100,000 more than they paid for it. So that's like a bonus, isn't it? Okay. So that's why the yield to call on a discount bond goes up even more. On a premium bond, of course, the exact opposite happens. They bought the bond at a premium price. Like here it says they bought it for $1,100, but it's callable at $1,030. Well, if it in fact gets called away from them, they'll get a check for $1,030, which is $70 less than they paid for it. So there's like a built-in loss of $70. Okay, so that's why the yield to call goes down even more. Now, this is usually where people ask me, why do people buy premium bonds? Why are you going to pay $1,100 for a bond that you know is going to get cashed in at $1,000? Why this $100 loss? Well, remember, why does the price of a bond go up? Well, one of the things that causes the price of a bond to go up are changes in interest rates. If interest rates go, in fact, we can use this. If interest rates go down, what happens to the market price of a bond? It goes up. So let's say if you've got a 6% bond, pays $60 a year. Interest rates have gone down since that bond was created. So new bonds coming out now pay 5%, $50 a year. If you've got a bond that pays $60 a year when other bonds pay $50, your bond looks pretty good, doesn't it? And it's worth it to somebody to pay more for it because they're going to collect a bigger check, right, every time the bond pays interest, every 6 months. Okay, Question, could I pull up slide number 56? Slide 56, get a screenshot. Okay. Oh, by the way, people have asked me, could I put up the PowerPoint?
Thank you.
Okay. All right. So the PowerPoint should now be available on campus. Question here says, so we don't know if it's a premium bond until the end of maturity. You'll know it's a premium bond when they give you the price. But they tell you what the price is. If the price is more than 100, that means more than 100%, it's a premium bond. If the price is less than 100, means the trade for less than 100% of its value, it's a discount bond. Okay. Now you can infer that also because if you know that interest rates have gone up since that bond was issued, right? If interest rates have gone up, the price must have gone down. If interest rates have gone down, then the price must have gone up. Yes, Trina, see your virtual hand.
Sorry, I'm just trying to understand. So I understand that based on interest rates, it'll tell you if it's a premium or a discount. But even then, like if once you know, why do they still purchase these premium bonds if you know already after the interest rates?
Okay, well, yeah, why did purchase a premium bond, right? Because a premium bond, the reason the price has gone up is because interest rates have gone down. And so this bond makes a higher interest payment, right, every 6 months. And so it's worth it to them to pay more for it because when they get a check every 6 months, it's going to be a bigger check. So it's worth them to pay a premium. Does that make sense?
I think so.
Yeah. All right. Anyway, if it's not totally 100%, please let me know. So this is the case. So this slide here, this is the seesaw diagram showing the relationship for discount bonds. You see when the price on the top one, the price has gone down, nominal yield at the center stays the same, current yield goes up, yield to maturity goes up more than that, yield to call goes up the most. And the exact opposite is true if it's a premium bond. The price has gone up, right? It's above 100, then the nominal yield stays the same, the current yield goes down, the yield to maturity goes down even more than that, and the yield to call goes down even more than that. Okay? And while it's not on the slide, but if the bond is a par bond, that means it's trading for exactly $1,000. That would look like a flat seesaw. Okay, the price hasn't moved, right? The price hasn't gone up or down, therefore the yield hasn't gone up or down. So if the bond's a par bond, then now, okay, all the yields would be exactly the same. Nominal, the current yield to maturity, yield to call would all be exactly the same. And again, I'm going to encourage you to, if you're not actually asking questions, keep your on mute and move on so there just doesn't end up being any background accident. It's happened before, by the way, on an unmuted line where let's say, shall we say a colorful phrase or expression could be heard. One that's not 100% conducive to our business environment, so probably best to avoid those sort of awkward moments. Okay, now some bonds are callable, but some bonds are puttable. A puttable bond is a bond where the contract says the bond investor has the ability to give the bond back to the issuer, and the bond investor can cash out prematurely and not have to wait all the way to maturity date. Put the bond back to the issuer. Again, usually after some period of time. Okay, can't usually do it immediately, but after the first few years or something, maybe they can. Now, why does an investor want to give the bond back to the issuer? They're more likely to want to do that if interest rates have gone up since that bond was issued. And now they could cash out this old bond with a low interest rate, get their money back, go buy another bond with a higher interest rate, and make more money from it. Okay, now this is something that's an advantage to the investor, right, and reduces their risk. Therefore, a puttable bond will have a lower coupon or lower interest rate than a non-puttable bond, all else being. Again, if I could ask if you can mute your line, the sound's going to come through in the back. I can do it for you from this end, if you want to do it first. Okay, next, now that we know some bonds, we do need to know about bond risks. Do anticipate questions. In fact, the biggest section on the test is investment products and their risks. So understanding the risks involved, so you want to know what they're called, so you can identify it by name. And of course, may include such things as how to mitigate some of that risk. All right. Go for it. Okay, so here are some of the risks with bonds. Okay, first off, one of the biggest risks of bonds, especially corporate bonds, is default risk, which is also known as credit risk. Default risk, credit risk, they're the same thing. They're synonyms. So it's basically the risk that, well, you lend somebody money and they don't pay you back. Okay, just like if you lend money to friends, some of them are more likely to pay you back than others. And just like you and I have a credit score, well, corporate bonds have credit ratings also. And there are two ratings agencies that we want to know for the test. There are more than that in the real world, but here for the test, two ratings agencies, and they are Moody's and Standard and Poor's. So it's basically someone's assessment or an evaluation of how likely it is that they can repay their debts. Okay. Okay. So if they, and by the way, so a higher grade bond, therefore, right, the highest grade would have a lower coupon, a lower interest rate. Just like if you and I have a high credit score, we get to pay a lower interest rate on our loans. And if they have a lower credit rating, well, then there's a greater risk, so they'll have to pay a higher interest rate. Just like if you and I have a high credit, if we have a low credit score, because someone thinks we're deadbeats, right, we're going to have to pay a higher interest rate. We're a bigger risk now. So they're assigned a grade, and it's kind of like you're back in school, okay? Where an A grade is a top grade, then B, then C, and then they start getting finer. So it's like instead of A plus, it's a triple A rating, right? Then double A, then just single A. Now Moody's goes BAA, where Standard and Poor's goes triple B. Then it's BA or double B, then single B. Again, Moody's is CAA and Standard and Poor's is triple C. Then it's CA or double C, and then C. Now, Standard and Poor's actually goes all the way down to a D rating. So way down here is a D rating, and D means like in default, already in default, already missed payments with a low chance of recovery. So that's about as bad as it gets. Okay. So notice some things here. First off, any A rating is better than any B rating, and any B is better than any C rating, right? Single A is better than triple B. Single B is better than triple C, and so on. And there's this cutoff line here where the top four, that's considered investment grade bonds, right? These are high quality bonds, top tier credit rating. So these are the ones you get for, for someone who wants a low degree of risk, right? Then below that, which you call speculative bonds, they could also say they're below investment grade. That's another terminology here, below investment grade. Right? Or they could say they're high yield bonds. But why do they have a high yield? They have a higher risk. Okay. Keep that in mind. Whenever you got test questions that says, what would you recommend? Everybody wants a higher yield. Not everybody wants higher risk. Always look for clues about how much risk someone is able or willing to take. Right? Use that as a guideline. And if you're not as polite about it, they call them junk bonds. Okay. All right. So those are some of the choices. So that's one. So the cutoff line, anything rated triple B and higher, or Moody's BAA and higher, is considered investment grade. It's the top four. Therefore, anything rated BA or double B and lower are considered speculative. And the test kind of looks as a speculative bond. It's kind of moderately aggressive at this point. So there's really going further out on a limb here when you're getting the speculative grade bonds. Okay. Question here says, is AAA equal to AAA plus? Okay. All right. I know sometimes there are even finer distinctions again in real world. They might even draw finer distinctions than that. For now, for the test, okay, just that AAA bond is the highest rating. Then it's AA, then single A, and so on. Okay. Could you give me a question example? Let me see an example of this. Okay. Here's one. Below which of the following uh, S&P rated bonds would be considered speculative? Okay. Below which of the following? So we have to find the one that would actually be anything below that would be considered speculative. Well, in that case, that would be triple B. Anything below triple B would be considered speculative. So that might be an example of how a question might show up. Karina, I hope that helps answer your question. If it doesn't, again, let me know, okay? Okay, thanks, Karina. Okay, now another thing here that often comes up is about interest rate risk and price volatility. Now remember, interest rate risk is the risk that if interest rates go up, the market price of bonds go down. Okay, so that's if someone wanted to sell their bond before it matured, yeah, they might not be able to sell it for as much as they paid for it because, right, new bonds coming out now pay more than the bond that they have. They might have to drop the price to convince someone to buy it from them. Okay. Now, here's the thing to remember, though, is that the longer the bond has to maturity, right, the longer it is until it matures, the greater the price movement. Because after all, if you got a 5% bond, it pays $50 a year, and new bonds pay 6%, $60 a year. Your bond is locked in paying 5% or $50 a year, right, for the whole life of the bond, right? It's locked in at that price. Now, if the bond's got maybe going to mature in another year or two, okay, sure, it's locked in paying a lower interest rate, but only for another year or two. So not that much time before you get your money back anyway. You wouldn't have to drop the price all that much. But what if that bond's got another 10 years, 15, 20 years to go? It is locked in paying a lower interest rate for another 20 years. That's a big deal. Then you'd really have to drop the price to convince someone to buy it from you. So the longer the bond has to maturity, the greater the movement, the up and down price swings, that price volatility. Volatility is the size and frequency of up and down price swings. The more volatile something is, the more up and down it is, the greater the level of risk there is. That's one way of looking at it and measuring risk is by price volatility. Okay. Okay. So also now bonds with higher coupons have less volatility. Lower coupons have more volatility. How come? Now a bond like a 10% bond pays $100 a year. Well, that's got more cash flow coming into it than a 5% bond does. Twice as much cash flow coming in. Okay? So therefore, if the bond investor is basically going to recoup their investment at a faster pace. Right? Whenever somebody collects cash, to at least some extent, it offsets their risk. So therefore, if the bond is a higher coupon, more cash is coming in, the more there is to offset the risk and therefore reduce the up and down price swings. Whereas a lower coupon doesn't have as much money coming in. So here's a question for you. Right? I mean, it's already on the screen here, but which type of bond, therefore, would have the greatest level of volatility to it? The greatest level of risk? You can unmute and answer. Bonds with lower coupons. What would have the lowest coupon of all? Amy says it right. A zero coupon bond, right? I mean, I know it's kind of gives away right here, but that's the whole thing, right? A zero coupon bond doesn't make regular interest payments. No cash flows coming in. Therefore, there's no coming in to help offset the risk. Now, here's something though that can offset interest rate risk: is you have a variable rate or adjustable rate bonds, or you might hear it sometimes called a floating rate. So in that case, it's having a fixed locked-in interest rate for the life of the bond. This bond has an interest rate that changes. So they'll compare it to some sort of outside benchmark. Maybe they'll compare it to what treasury bonds are doing right now, for example. So if treasury bonds are starting to pay more, then they're going to have a higher interest rate. The interest rate will change. And then, 6 months later, the bondholder is going to get a bigger check. On the other hand, if treasury bonds are going down, right, and have a lower yield, then this is going to adjust downwards too, right? And therefore, the bondholder doesn't get as much money. So because of this, right, it greatly reduces, if not eliminates, interest rate risk. Interest rate risk happens because bonds normally have a locked-in fixed interest rate, but this doesn't have a locked-in rate. It has an adjustable or floating rate. Okay. And again, now the other bond risk, okay, purchasing power risk is also called inflation risk. That's the risk that, well, you bought a bond for $1,000. 10 years later, the bond's going to mature. You get your $1,000 back. But 10 years from now, $1,000 doesn't buy as much stuff as it buys today. So we certainly hope that that the interest rate it collects is going to at least keep up with and hopefully exceed the inflation rate. Well, there's the risk that it doesn't. Marketability risk is how easy or difficult it is for the bond to sell. Now, government bonds are always an active market for government bonds. They're super safe, so they're always in high demand. Municipal bonds, however, that could have a high marketability risk because municipal bonds don't trade quite as much. And also, if you buy if you want to sell your bond, let's say you want to sell a New Jersey bond, who's going to buy it from you? Just another New Jersey resident, probably. It might be hard to move. All right, liquidity risk, kind of similar to market risk, but this says that liquidity can only be sold by using large transaction costs. Okay, like it talks about the quality here. Well, let's put it this way, right? An A-rated bond is a lot easier to sell than a C-rated bond. Okay, right. So therefore, it has less liquidity risk. A question here is about similar to money markets. Okay, that's a good point. A money market security is also a bond. It's a debt instrument that matures in under a year and has high credit quality, high credit rating. Because it's got such a short period of time before it matures, no more than a year, and by the way, usually a lot less than a year, that makes them very stable. So money market securities are considered cash equivalents. They're considered to be as safe and stable as cash. Right. That's a good thing. I'm glad you brought that up. Okay. Legislative risk, okay, is a risk that a change in laws, particularly tax laws, might adversely impact an investment. And notice it says it's a big issue for municipal bonds because states say that the bonds, if you buy a bond from your own state, that interest is also state tax exempt. Well, they could change their minds about that and pass a law that says no, it's taxable now. Not likely to happen, but it's conceivably possible. We talked about a bond that is a callable bond. Call risk is the bond gets called away, gets cashed out prematurely. Right? That's not a good news to the bondholder because they're going to have to reinvest their money probably in a lower interest rate environment. Business risk, right, is the risk you've invested in a business and the business is not performing like expected. And maybe the value of its investments reflect that poor performance. You can diversify, right, to minimize that risk, or at least to spread out the risk. That's where having a bond mutual fund comes in. We'll talk about mutual funds later on. Prepayment risk is specific to mortgage-backed securities, right? So a mortgage, that's when basically banks create a mortgage for someone to buy a house. The bank sells this mortgage to a government agency like GNMA, and they rebundle them and sell them to investors. So investors receive income when homeowners make their mortgage payments. Well, if interest rates go down, homeowners are much more likely to want to refinance their mortgages. And if they do, whoever bought that mortgage is going to get cashed out and get their money back sooner than expected. And now they have to invest it someplace else. And if interest rates have gone down, they won't get the same rate of return. Sounds a lot like call risk. It's similar to it, except that it's specific to when homeowners refinance mortgages. Reinvestment risk. Now, this is the risk that, you hold a bond, it makes a regular interest payment. Now, unless someone's going to spend that money, they're going to put it back to work and reinvest into other bonds. But if interest rates have gone down since that bond was issued, they won't be able to reinvest it at the same rate of return they did before. Now, zero coupon bonds don't have reinvestment risk because they're not receiving regular interest payments, so there's nothing coming in that needs to be reinvested. And of course, if you invest in foreign securities, then you have currency risk or exchange rate risk. Well, that's the risk that you have to convert yen, euros, pounds, Australian dollars, pesos, shekels back into US dollars. And if interest rates have become less favorable, you don't get as many US dollars for the same amount of foreign currency, and so its value can go down too. Okay, political risk also specifically to foreign investments. That's the risk that another country's policies or its laws or regulations might change and possibly have an adverse impact on investments. I would, for example, consider Brexit to have been a political risk. Because remember, for a while there, it was like, what's going on with the Brexit thing, right? Risk is uncertainty. Okay, questions is how are FX bonds or securities taxed? Okay, foreign securities, I mean? Okay. First off, as a U.S. citizen, any income that you receive anywhere in the world is subject to U.S. taxes. Okay, that's just how it is. Now, many countries, for example, they might have a withholding on taxes. Okay, so you've invested in a Japanese bond, for example, and you're supposed to get you're supposed to get paid in yen, but hey, the Japanese government could maybe hold 10% of it or something for taxes. So you're going to get the other 90% that's left. Now, fortunately, that is deductible on your US taxes, right? That's like a deductible expense. So basically, you'll get that 10% back but but you have to wait until April 15th when you do your taxes. Okay. Amy, hope that helps.
Yes, thank you.
Oh, sure thing. Okay. Here's the question is, why would it be bad for issuers to receive their money if homeowners refinance? It's the investors, right? Because they bought this mortgage, right? They have this mortgage-backed security, and they collect the interest and principal, right, when homeowners make their mortgage payments. Someone refinanced their mortgage because interest rates have gone down. And so they got the new mortgage and they use that to pay off the old mortgage. Well, whoever bought that mortgage got their money back to them, right? It's like a callable bond in that sense. They get their money back. Now they got their money back. They got to reinvest it someplace else. But interest rates have gone down, so they won't get the same rate of return they did before. That's why, from their point of view, it's not such a good thing. Like callable for mortgages. Yeah, that's kind of like that. All right, risks come in two major categories, as systematic and non-systematic risk. A systematic risk is one that's, well, basically part of the inherent to the system. Okay, it's a risk that is part and parcel of that type of investment. Interest rate risk for bonds, inflation risk, those are systematic risks. You cannot diversify against those types of risks. You can't spread those types of risks around through diversification. The non-systematic risks, those are risks that are individual to a specific investment, like business risk, for example, right, or default risk, and that's where diversification can help you out. That's where mutual funds come in. I describe it like you bought a bond of one company. You put all your money into the bond of one company. If that company goes out of business, you're out of business too. But you put it into a bond fund where you've got a portfolio of hundreds of bonds in different companies in different industries, and you spread the risk around. All right, maybe a couple of them go bankrupt, but hundreds more are still working for you, right? Okay. Okay. All right. With that in mind, let's go ahead and jump into chapter 4. So we've got the bond fundamentals, right? That's what we've covered so far. These are the things that are basically universal to bonds. Okay. Now of course, we have to have the fundamentals, but once we've got that, then we start drilling down and we start making finer distinctions as we go. Now, first way we're going to make a distinction is what type of bond is it by the issuer of the bond, right? Who created this bond? Okay, so the three major types of bonds by issuer, right, are corporate bonds issued by obviously corporations. Okay, government bonds also, or treasury bonds issued by the U.S. government, and then after chapter 5 will be municipal bonds, which are issued by state and local governments. And start from there, we're going to make even finer distinctions as we go. So first off, we're going to go with corporate bonds. So a corporation needs money, right? They want to build a factory, they want to hire a bunch of people, they want a fleet of trucks, whatever it needs, right, to build, grow, and expand the business. It takes a lot of money to do that. So they're going to issue bonds to borrow money from investors, and they promise to pay them back plus interest. Okay, so that's what. All right, now the way of bonds can be registered. The first one is called bearer bonds. Now, a bearer bond is an actual piece of paper. It's a fancy-looking piece of paper, okay, with tear-off coupons attached to it. You heard them. We called the interest rate on bonds a coupon payment. The interest rate is called the coupon rate because it used to be back in the day, bonds were printed on fancy pieces of paper that had tear-off coupons connected to them. And seriously, every 6 months when it was time to collect the interest payment, you would tear off a coupon, take it to the bank, and they'd give you your interest payment. They don't use tear-off coupons anymore, but the name sticks. Okay. So as a bearer bond, that means there was no registration as to who owned the bond. There was nobody's name on the bond certificate. It gets the name bearer bond because whoever has it, whoever holds the piece of paper, is presumed to own the bond. Well, that made them as vulnerable as cash to being stolen, right? And they were great for money laundering. So they haven't offered bearer bonds in the U.S. since like 1983. Okay, and by this time, even the oldest ones, they must have matured by this time. Okay, so bearer bonds no longer around, at least not in the U.S. All right, a fully registered bond, however, is in fact directed to the bondholder in their name. So if someone had the bond certificate, it's got their name printed on it, and therefore can be sent to them, right? But they don't need coupons anymore. They don't need tear-off coupons. Why? Because the name of the bondholder is registered. So they know the transfer agent who keeps the list of who owns how many bonds knows who to send a check to every 6 months. So they don't need tear-off coupons anymore. The way they're doing now for almost everything is called book entry. Book entry means there's no paper certificate. the name of the bondholder and social security number is all registered. It's all recorded electronically, and so they know who to send the principal and interest payments to, and they know who to send the 1099 forms to. Right. So, right, the 1099 forms tell you how much interest you earn. So they tell you and the IRS how much you earned in interest payments. All right, the indenture, right? That is the bond's contract. It's, after all, it's a deal between a issuer and the bondholder and the investor. And the contract says, I promise I'll borrow money from you. I'll promise to pay it back plus interest. Okay. And all the details in that, including, well, what's the interest rate? How much is the amount of the loan? Will it have a call or put feature? Anything else? Now, the major regulation that oversees corporate bonds is the Trust Indenture Act of 1939. This law specifies that for any issue of $50 million or more, with more than 270 days until maturity, I'll write them out to you, okay? More than 270 days to maturity, right? Has to appoint a trustee. All right, the trustee can be a bank or it could be a trust company, okay? That is there to basically be the go-between, the liaison between the bond investors, the bond holders, and the corporation, the bond issuer. And one of the roles of the trustee is to make sure that the bond issuer is living up to the covenants, right? To the rules of the bond indenture. If the bond indenture says, for example, they're going to have a sinking fund, which means that they borrowed all this money and they're going to promise to pay it back in 10 or 20 years, that they're going to put some money aside in escrow in the meanwhile, okay, right? So that they have this money ready when it's time to repay their loans. So they're going to make sure, hey, are you doing what you said you would do? All right, now this talks about the settlement. Settlement, by the way, the settlement is when securities are traded, right? There's a period of time it takes for money and securities to change hands. The regular way settlement, which means the standard method, okay, is, and it's true for almost everything, is 2 business days after the trade date. So once a trade gets done, it takes 2 business days from there for money and securities to actually change hands, right? The buyer gets the securities, the seller gets the cash. They abbreviate that typically as T plus 2 for a trade date plus 2 business days. Today's Monday. So if we execute our trade today, we're going to count 2 business days. We're going to count Tuesday and Wednesday. Wednesday will be the settlement date of the trade, the date where money and securities actually change hands. All right, now that's called regular way settlement, and it's done almost every time. There is something called the cash settlement, though, in which would actually have a same day settlement period. So the same day as the trade gets done, right? That's just T, right? Trade date, not plus anything, as long as it's done before 2:30 p.m. Eastern time. By the way, I worked as a registered rep for like 8.5 years. I never once took an order for a cash trade settlement. Not even once, not even close. Nobody even asked about it. It never came up. Nevertheless, it could still appear on the test. Not too likely, I think, but you never know. Okay, now when you do a bond trade, remember in the secondary market, someone buys a bond from someone else. So, as you know, bonds only pay interest every 6 months, twice a year. Now, unless it's like actually the trade happens on like that exact day that they make those payments, which is not very likely, well, then the bond buyer has to give the bond seller their prorated share of the next interest payments. Remember, whoever holds the bond tears off the coupon and gets a semi-annual interest payment. Right? So in this case, right, whoever bought the bond, right, on the interest payment date receives a check for 1/2 year's worth of interest. Well, whoever they bought that bond from held that bond for some period of time in between, right, the last interest payment until the time they sold it to someone else. So the person they bought it from is basically due their share of the next interest payment date, right? Their prorated share of that next payment. So the buyer's going to have to pay the accrued interest, right? That buildup of interest from the last interest payment date until the day before the settlement day of the trade. Remember, the settlement day of the trade is the day the buyer officially takes possession. Right? And that's then the buyer's name is on the books with the transfer agent as of owning those bonds as of the settlement date of the trade. So buyer's got to pay the seller their share of that. All right, I'll see if they. I'll look and see if they have actually a calculation for that. But Okay, but right now, so we know that bonds, okay, issued by corporations, now we're going to make a finer distinction. Corporate bonds can then be categorized into secured and unsecured bonds, depending whether or not there's any collateral behind that purchase, behind that bond. It's a loan, right? That's what a bond is. Well, they're borrowing money from investors to the tunes of millions, hundreds of millions, billions of dollars, okay, and promise to pay them back. Now, if they have any collateral behind that loan, that would make it a secured bond. So there's some asset, some property has been pledged as collateral for that loan, so that if the issuer defaults on the loan, right, the trustee will go ahead and, the issuer will quit claim the deed, and the trustee will sell, liquidate those assets, use the money, and pay back the bondholders to make them whole again. Now, from there, we're going to make even finer distinctions by the type of collateral that's been pledged for that loan. Now, a mortgage bond, okay, is backed by real estate, whatever type of real estate that the issuer has, a factory, a strip mall, okay, a parking lot, raw land even, whatever it is, that's going to be pledged as collateral for that loan. And if they default, they'll quit claim the deed. The trustee sells the real estate, uses the money, and pays the bondholders off again. Okay, all right. For the test, the type of company that often offers mortgage bonds, they typically tend to be utilities. Okay, they are the ones that tend to offer mortgage bonds, at least in the test. Okay, all right. In the real world, things can change, but for a test world, utilities seem to be the issue, mostly issue mortgage bonds. All right. Now, an equipment trust certificate, which, by the way, sometimes abbreviated as like ETC, right? It looks like etc. All right. Equipment trust certificate. That is backed by the equipment that the company uses to do the job. An airline will collateralize its airplanes. A railroad will put up its rail cars. A trucking company's fleet of trucks. All right. A construction company would put up its earth moving equipment. Okay. So for the test, it tends to be transportation companies that issue equipment trust certificates. If they default on the loan, they quit claim the deed on the equipment, sell off the machinery or equipment, and use the money to pay back the bondholders. A collateral trust certificate is backed by securities, and it's typically offered by a subsidiary backed by the securities of the parent company. As an example, Expedia, right, the online travel agency. Well, before it spun off as its own company, it was a subsidiary of Microsoft. Not everybody knows that. Okay, so if Expedia wanted to issue bonds as collateral trust certificates, that would have been backed by shares of Microsoft stock. If they default on the loan, they sell off the stock. By the way, they would never use the company's own stock as security, as collateral for the loan, because after all, if they default on their loan, they must be in like some pretty bad financial shape. And it's probably known that it's in bad financial shape, and the value of its stocks are probably going to reflect that bad financial shape. So putting up its own stocks as collateral when the company's having trouble making payments, right? Those stocks won't be worth very much. So it's got to be the stocks of someone else, some other company's securities, not its own. Okay, all right. So those are the secured bonds backed by some collateral. Now we also have unsecured bonds, okay? And an unsecured bond is also known as a debenture. That's just another word for it. So a debenture is a name for an unsecured loan or unsecured bond. Unsecured means there is no collateral. There is no property that's being pledged to back up that loan. As they say, it's backed by the issuers. The words they use, the issuer's promise to pay, is faith and credit of the issuer. Their good name and their promise to pay. Now, before they can issue an unsecured bond, they're going to have some credit, aren't they? They're going to have a good name. So it won't be like a brand new company, right? They'll have to be seasoned for a bit before they can offer some kind of debenture. Which one, though, do you think has a greater risk to it? A secured bond or a debenture? You tell me. Oh, the question was Microsoft their security? Yeah, if that was the case, yes. I'm just making that up, but if it were the case, yeah, it would have been backed by Microsoft. So, which one do you think has a higher risk? A secured bond or a debenture? Okay, Karina, Amy, I agree. Right, a debenture will have a higher risk. Therefore, which one would have a higher coupon, all else being equal? A secured bond or a debenture? You got it right. A debenture would have a higher coupon, a higher risk. You got to offer them a higher interest rate. Okay. Now, some of them here, they talk about a particular type of, which is called commercial paper. Commercial paper is for when company needs short-term financing. Okay. Usually they have to purchase inventory, sell the inventory, and then pay off their loans. Okay. So as they say, they have very short maturities. The slide here says 14 to 90 days is the common, but the regulation is no more than 270 days. Why 270 days specifically? That's because the SEC says if a commercial paper 270 days or less, right, until its maturity, is exempt from registration. So now 270 days is about 9 months, okay, but it is more precise to say 270 days. And I say that because I once saw a practice question that says a company issued commercial paper that matured in 280 days. 280 is not 270. So that would not be an exempt from registration. Okay. All right. Now, often by the way, they can be sold with a coupon, make regular interest, but since they're such short term, they're usually bought at a discount and mature at their face value, right? Pay $950, get $1,000 kind of thing. Okay. Now, they also tend to be in large amounts. So they sold in units of like 100,000 on up. So not everybody can buy and sell that, can afford to. So it's usually financial firms that purchase commercial paper. Okay. All right. But that would also be an example of a debenture. So a debenture, though, is a bond, okay, that has, backed by, again, the faith and credit of the issuer. Okay. Yes, Jason.
So that bond, the commercial paper, that's something they invest the $100,000 or the $1 million, and they get back a certain amount of money within the 1490 or 30 days.
Yeah, that's right. Yes, exactly. Right.
So how is that interest process? How's that working?
Well, usually they're purchased at a discount. So they might buy it for, I don't know, 999,000 or $99,900 or something like that, and get $100,000, when mature, right? Pay this much now, get that much later.
Oh, plus your money back, and then obviously the interest or the payout is taxed.
Yes, okay. Yeah, it is subject to tax, yes. Okay, yeah. You have to figure just about all income is subject to tax. Anything else is an exception to the rule. All right, now there's another class of a debenture called a subordinated debenture. Oh, thank you, Jason. Subordinated, right? It's the prefix sub, right? Sub means under, like submarine, right? It means under the water. All right, a subordinated debenture comes under other bonds. So companies that issued bonds before, they issue subordinated debentures, which means they're in a lower or a junior status. Okay, that's usually the word they use, right? They're junior to other securities, which means that if there's a bankruptcy liquidation, right, okay, and the bankruptcy judge says you sell everything you have and you pay off your debts, well, all other debts have to be paid before the subordinated bonds can be paid. And if there's not enough money, okay, to pay them off, then the investors are just that's the way it goes sometimes. Think of it like the second mortgage on a house, right? Yeah, okay, yeah. When someone sells the house, right, they use the money from the sale to pay off the first mortgage, and then with what's left over, they pay off the second mortgage. Well, hopefully there is enough left over to pay off the second mortgage too. But if there isn't enough money, the second mortgage holder is just plain old out of luck. Okay, so which one do you think has a higher risk to it? A debenture or a subordinated debenture? Sub or sub debenture, right, Amy? Therefore, which one will have a higher coupon? A debenture or a subordinated debenture? Yes, actually, it's exactly it, right? Higher risk, got to offer them a higher interest rate. Okay, so that's the risk of some more. And yes, investors will know, right, that it's a subordinated bond. Okay, so they only get paid if after other debts are paid. Okay, a guaranteed bond. This is like this is usually issued by a subsidiary, but it's backed by the parent company. All right. Now again, it's not the collateral trust certificate. There's still no collateral here. It's just a second promise to pay. It's like this. Like, did your parents have to co-sign on your first car loan? So if you don't make your car payments, your parents are on the hook? kind of like that. There's no collateral. It's just if the subsidiary defaults, the parent company promises to pay. Therefore, these guaranteed bonds have the credit rating of the parent company. Then there's this one called income bonds, also called adjustment bonds. This is the worst name for a bond ever, an income bond, because they don't give you income. They call this because these are issued out of bankruptcy proceedings. So the company is declared bankrupt, and the bankruptcy judge orders the existing bonds canceled, right? They're canceling their debts and replaced with these income, also called adjustment bonds. And they get the name because the issuer, the corporation, only makes interest and principal payments if the company has the income to do it. And considering that this is a bankruptcy situation, that's a pretty big if. This is the junkiest of junk bonds. Okay, so here's like a typical thing they try and tell you. They give you a question that goes, you have an investor, a customer who's looking for income. What would you recommend? And one of your answer choices might be income bonds, which if you didn't know any better, you might think, well, that's what they're looking for, right? No, that's the trap that they're going to set for you. Income bonds don't give you income. They're out of bankruptcy proceedings. Okay, that's the worst thing. Now they say they're called trading flat. That means they do not have trade with accrued interest. That's the term, right? If a bond is not building up accrued interest, it's trading flat. Zero coupon bonds, by the way, right? Also trade flat. So when someone sells or buys a income bond, no, they don't have to pay. Buyer does not have to pay seller any accrued interest because they're basically working on the assumption that they might not pay any interest anyway. Okay. You say, what kind of investor wants to buy an income bond? Probably someone with a death wish. Right? Actually, probably say they don't have a choice. Right? The existing debts were canceled, the bonds were nullified and replaced with this. So it's like that or nothing, basically. All right. Let me see what's our next one here. Because before we go on and talk about convertible bonds, because that's going to take a little more time. We're right at the top of the hour, so I think this is a fine time to take a break. So let's go ahead and take 10 minutes and return at 11 past the hour. Whatever the hour is in your time zone. Oh, wait a minute. We're all in the same time zone. I get you. So in my daytime classes, I talk to a national audience sometimes. So, okay. So, so let's return basically at 11 past. As always, if during a break, if you have a question, if you want me to go back to an earlier slide, you can type it into the chat or you can unmute and ask, and then, I'll reply to you accordingly. Okay. On that, see you in a few minutes. All right, and welcome back from break. Okay, and if I can be sure that I am, welcome me back. And I haven't lost my connection. I'm not talking to dead air or anything. If you can unmute and say hello. Okay, thank you, Ashley, Hannah. Okay, Colby. Okay, Karina, thank you. All right, Amy, thank you. Okay, I'm going to take that as a good sign that things are working properly. Okay. All right. Okay, so now let's start talking about another debenture, which is a convertible bond. Convertible, that means that the bond holder, the investor, has the ability, thank you, Jason, has the ability to swap their bond for so many shares of the company's common stock. Right? So the bond would have a certain conversion ratio. It might say on the bond certificate that says this bond can be converted into, let's say, 20 shares of common stock. Well, if you take that bond and turn it into so many shares, it's like being able to buy the company stock at a fixed price, right? At a pre-agreed price, no matter what the actual price is. Okay. Now, when the bond is issued, right, that conversion price that it is, that pre-agreed is higher than the current price, at least at the time. But hey, maybe after a few years' time, hey, it could end up being really good. So being able to have a convertible bond allows a bondholder, right, who's a debt or the creditor, to be able to participate in the growth of the common stock without the risk of the common stock. Because if the stock does well, then they can take their bonds, swap it into so many shares of common stock, sell the stock for a profit. But if the bond doesn't go anywhere, or say if the stock doesn't go anywhere, well, you still got a bond and you're still collecting interest payments. So a little best of both worlds. Okay. Now so the bond might have a certain conversion, a conversion price or a conversion ratio. Let me just check real quick if there's a slide for it here. Okay. Yeah, yes, there is. Okay, so let's go into it. Now, the thing is, so it says there's a thing about arbitrage. Okay. So it might be possible sometimes where the price of the bond is not so much in sync with the price of the stock, right? If you convert them into so many shares, that would give you a certain value to it. Well, maybe there's a discrepancy between the market price of the bond and the market price of the underlying stock. And maybe sometimes you can take advantage of that price discrepancy and buy the convertible bond at a lower price, swap it for shares of stock, and sell the stock for a slightly higher price. That's called arbitrage, right? That's taking advantage of these price discrepancies. All right, so let's see how this works. So what we have is it says we have a 10%, remember that 10%, that's its interest rate, or that's its coupon, or its nominal yield. It pays 10% interest of a $1,000 par bond, right? Which means it pays $100 a year. And the bond is issued with a conversion price of $50. So this says you can take your $1,000 bond and swap it out for shares of stock at $50 per share. So then it asks, if it gave you the conversion price, what's the conversion ratio? Conversion ratio is how many shares of stock do you get for every bond? Well, this is I'm going to say you already know how to do this. It's like making change. Because let's say you have a $1 bill and you can swap it for nickels at 5 cents a nickel. Well, then how many nickels do you have? You know you'd have 20 nickels as a result of that. Well, if you have a $1,000 bond and swap it for shares of stock at $50 a share, right? 50 shares, how many shares of stock would you get for your $1,000? You'd get 20 shares. So you do this for the conversion ratio. If they give you you take the par value of the bond, which again is $1,000, right? Industry standard, so it's a safe assumption for the test, and divide it by the conversion price that they gave you. The $1,000 bond divided by $50 a share is 20 shares. So as we say, it's a 20-to-1 ratio. Okay, so we can take this bond and swap it out for 20. It's like buying 20 shares at $50 a share at a fixed price. But what if the actual price is $60? Right, the price has gone up. So therefore, what would that bond be worth? If you can take the bond, turn it into 20 shares of stock, sell the 20 shares at $60 a share, how much money would you get from that? 20 shares at $60 a share, you'd get $1,200. Now, if you owned that convertible bond and you know you can exchange it for 20 shares of stock, you know that you can sell the stock and get $1,200 out of it, would you want to sell your preferred stock for anything less than $1,200? Would you let it go for anything less than that? I trust that you said no. And you'd be wise, okay? Right, because it's worth, right, because that's its equivalent value, right? That would be its parity. Parity means equivalent value, or equality or equivalent value. So this bond, you figure, should be trading at $1,200. Maybe a bit more up or down from that, but it should be right about there, $1,200, because that's the equivalent value if the underlying common stock is currently $60 a share. So to find the parity, the equivalent value of the bond, we're going to take the conversion ratio. Right? That's the number you need. We need the conversion ratio. How many shares of stock do you get? To multiply that by the market price of the stock. And the bond that would be the equivalent value of the bond. Right? Now, on the other way, they could describe it differently. They could say, we have a 10% bond, $1,000 par, convertible into stock at $50 a share. So again, its conversion ratio is 20-to-1. 20 shares of, right? Okay, it's like if you can take $1,000, buy stock at $50 a piece, you get 20 shares for that. Now we're also going to say now that the bond is currently trading for $1,400. That's its market price. So if someone buys the bond at its market price of $1,400 and they swap it out for 20 shares of stock, it will be like buying 20 shares at $70 a share. So therefore, the parity of the stock, once we know the market price of the bond, then the parity of the equivalent value of the stock is we take the market value of the bond and divide by the number of shares you get by the conversion ratio. Okay, so that's how it works. Now, the way we can remember that, let me put this on screen here. This is one of your phrase that pays. Okay, is that we commonly multiply, and we are bound to divide. We commonly multiply and we're bound to divide. So if you know the value of the common stock, you multiply it, right? You multiply the number of shares of common stock by the market price, and that will give you the parity of the bond. But we are bound to divide, which means if we know the value of the bond and we divide that by the conversion ratio, that will give you the equivalent value of the parity of the common stock. Okay. Does that help you out? Okay. As always, with any kind of formula like this, as a formula, it means you do the same thing every time. So the best way to learn it is to go into the practice questions, go get questions on the topic, and just do them over and over again. Right? You basically, right? It's a formula. You always do the same thing every time. Get some numbers, make up some numbers, and crunch them to the formula, and do it so many times that by the time you're done here, right, it's on autopilot. You've just done it that many times. Okay, so what are the advantages, of course, to the issuer? Why would an issuer want to give a convertible bond? Well, first off, the advantage to the investor is that they can swap the bond in for shares of stock and participate in the growth of the stock. That's an advantage to the investor. Well, therefore, since there's an advantage to the investor, right, the trade-off is it has a lower interest rate, a lower coupon. So all else being equal, a convertible bond will have a lower coupon than a non-convertible. And investors are willing to take a lower interest rate because of the possibility of being able to swap the bond into shares of stock and participate in the growth of the stock. Therefore, the issuer, the corporation, gets to pay a lower interest rate on the bond. Now, there is a thing called a forced conversion. That's where a bond is both convertible and callable. So the issuer says, we're going to call the bonds in and cash out and give you $1,000 back. Well, the bond is also convertible, which means you can swap it for shares of common stock. Now, if it's profitable, right, if it's the common stock is worth more than $1,000, then, well, you pretty much got to. They're not forced to, but you'd be leaving money on the table if you didn't. So it would just make sense, right? So if the bond is called away, well, either you let it call them away from you, give you your $1,000 back, or you swap it for shares of stock and sell the stock for a profit. And whichever one you get more money out of, well, that's the one you do. Okay. All right, here it does mention here a disadvantage of a convertible bond, and that is, all right, bonds pay interest, but stocks pay dividends. Now, interest payments are a ordinary and necessary business expense. They're tax deductible for the issuer, for the corporation. Dividends, however, right, are not deductible. Right, so their dividends are paid with basically with after-tax money, right? Whatever the corporation has after they pay taxes, that's what's left over to pay as dividends to stockholders. Stockholders then pay taxes on the dividends that they receive. Okay, we already mentioned here about the advantage to the bondholder, possible capital gains. Dividend payments are often taxed at a lower interest rate, because interest is taxed as ordinary income, whatever tax bracket someone falls into. Dividends, what they call qualified dividends, are taxed at a lower rate, or called a preferential rate. The disadvantage, well, we've already talked about the trade-off, right? A lower coupon, a lower interest rate. So every 6 months they don't get as much money, but they figure it's worth it for the chance of the gain. All right, we did mention this briefly, which is a liquidation priority. Okay, so what happens when a corporation is declared bankrupt? Okay, what is the bankruptcy judge going to order? Now, this is liquidation bankruptcy, not reorganization. Liquidation means this company's done, it's over. The judge says, sell everything you have and use the money to pay back your investors. What order, who gets paid off first and next and last? All right, first in line are the secured creditors. Remember, secured bonds, those are the ones that have collateral that has been specifically applied to that. So their first step is liquidate liquidate that collateral, use that to pay the secured bondholders. After that, right, then they're going to pay off. Well, it's back wages, back taxes, and general creditors. A general creditor means anyone who this company owes money to. These are like unpaid bills, right? They're suppliers. Okay. Welcome back to part 2 of day 3. All right, so here's the we always said first secured bonds, right, which are backed by collateral, then wages, back taxes, and general creditors like unpaid bills. Then it's the debentures that are paid, right, the unsecured bonds, and then it's the subordinated debentures. Now, numbers 1 through 4, these are all the debts that they have. So the test question might lump them all together, and they just might call these right bondholders. Okay, they just might call them, just give them the one name bond or just lump them all together. Now, once all the debts are paid off, then they're going to pay off stockholders. Preferred stockholders, well, they have preferential treatment over common stockholders in 2 places, and one is the dividend payments, and the other, of course, is in bankruptcy liquidation. So preferred stockholders get money back before common stockholders, and then last in line, okay, the most junior security, right, after everything else is paid off, after they paid off all their bills, after they paid off all their preferred stockholders, if there's any money left over at this point, and don't hold your breath, then common stockholders get paid. So who's got the, okay, now the test could, of course, lump these two together and just call them stockholders. Yes, Jason.
So, like, what happens if the common stockholder is like, they invested, they bought, 200 shares at, $500 a piece, and they only have like enough to pay them, $190 each. What goes on in that type of situation?
Well, you just described it. That's what goes on, and then the common stockholders, they've lost the difference, but at least they got something out of it in this case. When they're last in line like that, there may not be anything, right? Look how many things have to get paid off first before common stockholders get anything. So, yeah, they might not get anything by that point. Yeah. Okay. All right. I hope that answers your question, Jason.
Yes, that did. I did.
Okay,
get that.
Okay. Yes, Karina.
If you're a preferred stockholder, what would it be common for not all preferred stockholders to be paid back, or is it like kind of the luck of the draw?
Well, okay. In terms of like some stockholders get something and some get nothing. Is that what you mean? No. Okay. All preferred stockholders will get something. They may or may not get their $100 par value back. Maybe they'll only get 20 cents out of every dollar. Who knows? But all preferred stockholders will get something. There won't be any, you get this much, but you get nothing, thankfully. Okay. All right. Because the ones who got nothing sure would be upset, wouldn't they? Okay. All right. So who's got the greatest level of risk in this situation, right? Common stockholders have the greatest level of risk. Who's got the least amount of risk? Secured creditors. On the other hand, who's got the most profit potential? Common stockholders. Who's got the smallest amount of profit potential? Secured creditors. Okay. All right. All right. Next section here. So we've gone through everything about corporate debts. Now we're going to go into our next part here, which is about government debt, government and agencies. All right. So when they talk about government debt, they're talking, of course, about the U.S. government, the federal government, and they talk about it from the Treasury Department. So the Treasury Department is, well, basically, I think of them like the checkbook of the United States government. Okay, and their role, of course, is to manage the finances of the U.S. government, and of course, to stimulate economic growth. So when the U.S. government needs to borrow money, and boy, do they need to borrow a lot of money, they will issue government debts, right, which are guaranteed by the faith, credit, and taxing power of the U.S. government. So they're unsecured bonds, right? There's no collateral that's been pledged, all right, just no property that's been pledged, but it's backed by the faith and credit, but also the taxing power of the government. Now, the taxing, right, that means that they can always exercise their taxing authority to ensure the bonds are paid. And no matter what else happens, right, despite of everything, U.S. government bonds are still considered to be the safest bond, the safest investment in the world, right? They're virtually default risk-free. Now, the Treasury Department issues different types of securities, for the most part, depending on how much time there is from the time the bonds are issued until they mature. So they offer them in short, medium, and long terms. The short terms are called Treasury bills or T-bills. When I say short term, I mean they come due in less than a year, anywhere from 4 weeks to 52 weeks, all right, but always under a year. Treasury notes are medium term, they're anywhere from 2 years to 10 years, and Treasury bonds are long term, those are 10 years plus, anywhere from 10 to 30 years. They're certainly issued in book entry form, there is, right, so they're fully registered as to who owns it, right, and recorded electronically. There's no piece of paper, not anymore. Treasury bonds are considered negotiable also, which means that they can be traded, right? There's a market for them. So you buy one, you buy a bond, you can sell it to somebody else. And if you can sell it for more than you paid for it, you can make a capital gain on it. They also have savings bonds, which are non-negotiable, which means you cannot trade them. Instead, they have to be redeemed. They are redeemable, which means when they come due, you have to take it back. Well, you can take it to the bank and get your money back. Now, these are known, well, we see them most commonly as what are called Series EE bonds. Series EE. Okay, so they're EE savings bonds. You can basically buy them for as low as $25, and after some period of time, they come due and they mature at $50. Probably will take a while, but you can. Okay, so they're offered at a discount and mature at their full value, like a zero coupon bond. There's also another, I don't know if they're actually around anymore. They're called Series HH. Series HH bonds, they make semi-annual interest payments or coupon payments. So you get payments on a regular basis. Now, the ones you might have heard in the news most recently, the Series I bonds, right? That's right, I for inflation protection. So they have a savings rate or an interest rate that is tied to the consumer price index. So in periods of inflation, these are going to pay more. And yes, when I heard that Series I bonds were going to pay almost 10% interest, government guaranteed, I'm like going, yeah, I don't have it. I got to. So I opened an account with Treasury Direct, right? TreasuryDirect.gov, and I purchased like $5,000 worth of Series I bonds. I haven't checked them like that. Maybe I should. Okay. All right. So any bond that's issued by the U.S. government, okay, is virtually default risk free. Now they're still subject to other risks though. They're still subject to things like interest rate risk. If interest rates go up, the market price of bonds go down, and that's true for government bonds too. Okay, but they're just free from default risk. Now, GNMA, which is the Government National Mortgage Association, that's a government agency, but it is actually part of the U.S. government, and therefore is also backed by the faith, credit, and taxing power of the United States government. Okay. It does mention here about government-sponsored, well, they say government-sponsored agencies. They're called government-sponsored enterprises, GSEs. These are corporations that work under government contract, or they've been privatized, right? They were a government entity, now they're a corporation. You can even buy stock in them, like FNMA, Federal National Mortgage Association. So they would say that they're implicitly backed. They say they're government-sponsored, but not directly government guaranteed. So potentially there is a default risk. Yes, back in 2007, right, in that subprime housing crisis, yes, the government did vote to bail out Fannie and Freddie. Congress bailed out Fannie and Freddie, but it took an act of Congress to do it. GNMA, they didn't have to because that's explicitly government guaranteed. All right, so Treasury bills, T-bills, we know that bonds usually pay interest every six months, but Treasury bills might not even last 6 months. So how do investors make money from Treasury bills? Because they're a zero coupon bond. They're purchased at a discount and mature at their face value. Maybe you buy it for $975 and you get $1,000 when it matures. The $25 difference, that's the interest you earn. Okay. All right. So when you get a price quote on a Treasury bill, these work differently than most other bonds that you see. Let me just look real quick and see if they have an example. I don't see one, so I'm going to have to give you one. So when you get a price quote, the way it works is it doesn't tell you so much the price, it tells you how much of a discount it is from its par value of $1,000. So if I gave you a price quote, let's say it's bid at 2.0 and ask 1.5. Okay, now when you look at this, that looks a little strange. Normally, the ask price is greater than the bid price, right? The price you buy it for versus the price you sell it for. But this makes it look different. But what it really means is that's how much percentage discount is from par value. The bid is 2.0, which means it's being bid, right? If you wanted to sell it, there's a dealer willing to buy it from you at a 2% discount. Now, if you take, well, what's 2% of $1,000? Well, you can take 1,000 times 0.02, and that would be $20. So it's a $20 discount from par value. So the $1,000 par value minus the $20 discount is $980. So if you wanted to sell it, there's a dealer willing to buy it from you for $980. Now the ask price is 1.5. So which means, again, that means it's a 1.5% discount from its par value. Well, what's 1.5% of $1,000? Well, it's $15. So you take your $1,000 value, subtract out the $15 discount, and if you wanted to buy it right now, there's a dealer willing to sell it to you for $985. That's what this bid is, right? That's what the price quote is. Doesn't show up a whole lot on tests, or at least not on practice tests, but hey, you're prepared now just in case you do. Okay, now, by the way, as it says here, the par value for them is $1,000, but you can buy them from treasurydirect.gov actually for as little as $100. Nevertheless, we're going to still consider par value to be $1,000. Now, Treasury notes, as I said, they're anywhere from 2 to 10 years from issue date to maturity date, and like other bonds, they're sold at par value of $1,000 and make semi-annual interest payments, right? Every 6 months, collect your interest payments. The only difference between Treasury notes and Treasury bonds is how much time they have from issue date to maturity date. T bonds are long-term, that's more than 10 years, out to 30 years. They also are sold at par value, $1,000 par, but you can buy them, like it says, for $100. Still now, we're going to call them $1,000 par value and make semi-interest payments. Now, if someone wants to buy a bond from someone else, how much accrued interest does the bond buyer have to pay the bond seller? How much basically in interest do they have to pay them? All right, now corporate bond and municipal bonds, okay, the way they work for corporate municipal bonds is that to do the math, how much money does the bond buyer owe the bond seller? They work what's called a 3360 basis. 3360 basis, which means that there are 30 days in a month and 360 days per year. Right, now just to do the math on it, just every month is 30 days long. January, February, March, and April are all 30 days. Okay. However, government bonds or treasury bonds is a much bigger market. Okay, there's much more dollars involved, and so they have to draw finer distinctions. For government bonds or treasury bonds, they use an actual basis, which means that it's the actual number of days in a month. So that means January is 31 days, February is 28, March is 31, April's 30. And there are 365 days per year. Please don't worry about leap years, okay? They're not going to get into that. Okay. All right, so how do we figure out how much interest bond buyer owes bond seller? So I didn't see slides for it, so we're going to walk through this now. So let's say the bond we have, I'll start with corporate bonds first. So we have an ABC Corporation, 6% bond that is matures, let's say in 2033, and is a J&J bond. J&J means January and July. It's not Johnson & Johnson. It's January and July. So it pays interest. You tear off a coupon January 1st and July 1st. Right. So now, of course, it was an F&A bond. Okay. That would be every February, August, or every March, September, and so on. Well, let's show it for the moment and just say it's a J&J bond. So it pays January 1st, July 1st. An investor buys the bond on, I'll say, Wednesday, April 11th. Wednesday, April 11th. Okay. Now, how much interest does the bond buyer owe the bond seller? The buyer owes the bond seller interest or accrued interest from the morning of the last interest payment date, which would be January 1st, until the day before settlement. Okay. And by the way, we include weekends. We include weekends and holidays. By the way, settlement periods have to skip over weekends and holidays. Accrued interest includes weekends and holidays. Why the day before settlement? Because remember, the bond buyer takes possession on the settlement date of the trade, 2 business days after the trade date. The bond seller still had it until the day before the settlement period, so the bond buyer owes the seller from the last interest payments until the day before settlement. So first off, we have to ask, how many days of interest does the bond buyer owe the bond seller? With corporate bonds, we just work under the assumption that every month is 30 days long. So January is 30 days, February is 30 days, March is 30 days. Then we've got how many days in April? If the purchase date was Wednesday, April 11th, and corporate bonds have a 2 business day settlement, what's the settlement date of this trade? Who can tell me? Two business day settlement. So it was purchased, the trade date was Wednesday, April 11th. Settlement is trade date plus 2 business days, or T plus 2. Friday, right. Friday, April 13th. Hey, Friday the 13th, right? Okay, so what's the day before settlement? Wednesday, April 12th. So our running total now, so they'll owe them 12 days worth of interest in April. Add them all up, 30, 30, 30, that's 90 so far, plus another 12, is 102 days of accrued interest. Now the next question might be, how much in accrued interest in dollars and cents does the buyer pay the seller? Okay. All right, so how much, first off, we know it's 102 days. Now, how much does this bond pay annually? It's a 6% bond. How much does that pay per year? How much? Yes, Amy, $60 a year. And okay, now they owe them 102 days of interest. So our next step is figuring out what is the interest payment date, how much interest accrues on a daily basis. If it's $60 a year, and there are 360 days in a year, how much is that per day? Well, this is definitely time to get your calculator. So I'm going to grab my calculator. All right, so I'm going to take the 60, divide by 360, and I get 0.166666667. Okay, like that. Okay. Now, I'm not going to clear my calculator, and I'm not going to round it off. I'm going to take this number I got, because basically it's paying 16 2/3 cents a day. So I'm going to take the number I have. I'm not going to round it off. I'm not going to clear my calculator. I'm now going to take what I see here and multiply by the number of days, 102 days. So I take this number times 102, and I get, oh my goodness, this is amazing. I get $17, 17.00. Now, if I go back further, there's a lot of zeros here, 0.34, but now I'm going to round it off to 2 decimal places, right? Dollars and cents. So when the person who buys the bond bought it from the seller, the bond buyer has to pay the seller an additional $17 per bond for that prorated period of time, for the 102 days that the bond seller still had the bond. Because remember, the person who buys the bond tears off the coupon. On July 1st, bondholder is going to collect $30, right? Because it's $60 a year, right? Every 6 months, 2 $30 payments. So on July 1st, they're going to get $30, but the bond buyer owes the seller $17 out of that 30 for the period of time, right, that the bond seller still hold the bond until they relinquished it. Okay, welcome back to the class. This is part 3. All right, so we just did the accrued interest for corporate and municipal bonds. The rules change, however, when it's a government bond. So let's say we're going to, instead of being an ABC corporate bond, let's make it a treasury bond. Okay, that's also January and July, bought on Wednesday, April 11th, and accrued interest from the last payment date until the day before settlement date. Now, in this case, what's the day before? Okay, what's the day before settlement? Settlement on government bonds happens in 1 business day, not 2. Treasury trade date plus 1. So if it was bought on Wednesday, April 11th, then the settlement date is Thursday, April 12th. Then therefore the day before settlement would be the same day as the trade date itself, Wednesday, April 11th. So the buyer owes seller for until Wednesday, April 11th. Now in this case, we have to count what? Actual days. Actual days. So January is 31 days. February is 28 days. Again, don't worry about leap years. March is 31 days. And it's now 11 days in April. For how many days total? Well, this time I think I'll use my calculator. 31 plus 28 plus 31 plus 11 is 101 days. Okay. All right, the question here is, how did I figure out the days of interest from January through April? Okay, so now remember, for a government bond, I had to use actual days. January is 31, February is 28, March is 31. How many days in April? Remember, for a government bond, okay, accrues from last interest payment date until the day before the settlement. Since government bonds settle in 1 business day rather than 2, so the settlement date would be Thursday, April 12th, and the day before that would be, well, we're right back to Wednesday, April 11th. So for a government bond, right, we count interest, right, the accrual, really right up through the trade date itself. So it's 101 days. Okay, so Karina, did that help answer your question? Okay, good.
Thank you.
All right, now we're going to say, so it still is a 6% bond. It pays $60 a year, but now it's 365 days in a year. So what's the interest payment per date? I'm going to take my 660, divide by 365, and what I get is 0.164383, etc., etc., etc. Okay. Again, I'm not going to clear my calculator, and I'm not going to round off to anything. I'm just going to take this number that gives me in my calculator, multiplied by 101 days. Okay, so picking up where we left off here, 16.16 cents a day times 101 days. So I'm going to multiply by 101, and I get $16.60 rounded to the nearest penny. At this point, of course, I do have to round to the nearest penny because, well, we can't do fractions of a penny here. Okay. Anyway, I hope this helps you out here. This is how you do the accrued interest. As always, it's a formula, so you just keep practicing it. You do the same thing every time. Now, how do you remember, ways to remember how many days there are in a month? All right, there's actually a couple ways here. One, there's an old poem. Who knows if maybe you heard it, but the poem was, right, 30 days hath September, April, June, and November. So you can remember that as a poem. Therefore, everything else is 31 days except for February. Here's another thing you can do too. You can do this little trick with your knuckles. Okay, so if you look at your knuckles from this end here, you've got, right, a series, basically it's a series of peaks and valleys here, okay? Every peak that you see represents 31 days, and every valley represents something other, right? Usually 30 except for February, right? It's 28. So if you look at here from left to right, one is the peak here, is that January is 31 days because it's on a peak. In the valley here, February, right? Okay, is well, in this case 28. March is another peak, that's 31 days. April is a valley, so that's 30 days. May is a peak of 31. June is 30 days. July is a peak, that's 31 days. Switch over to this hand. Next is August. This is also a peak, that's 31 days. September is a valley, is 30 days. November is 31. October. October comes next, is 31 days. Then a valley is November, is 30 days. And then December, right, also a peak, is 31 days. So either way, it'll work. And you can remember, if you need to come up with quickly how many days there are in a month, you can do that poem, or you can do this little trick with your knuckles. All right. The next type of treasury security is a treasury strip. Treasury strip is they took a government bond, they took a treasury bond and stripped it of all of its coupons. They just basically ripped all the coupons off of it. So if you imagine you're holding a paper treasury bond certificate, you've got a promise, okay, which says it's worth $1,000, and then there's all these coupons connected to it. You tear one off every 6 months. But they just ripped all the coupons off of it. So now you've got a promissory note for $1,000, and you got a stack of coupons. Then what they do is to sell all these things, right? They sell the promissory note and they sell the coupons at a discount to the money that's due. So what they do is they basically have created a string of zero coupon bonds. So treasury strips, they're like treasury bills, except they last longer than a year. So you might buy the treasury bond. It has $1,000 face value and matures in so many years, 20 years maybe. You pay, maybe you'll buy it for $600, okay, at a discount. All the coupons now, let's say it's a 5% bond. It pays $50 a year. That comes in the form of two $25 payments 6 months apart. So the first coupon comes due in 6 months for $25. Buy it now for $24, get $25 in 6 months, government guaranteed. The next coupon comes due in 12 months. So maybe you buy this one for $23, and 12 months later you get $25, government guaranteed. And the next one is in 18 months, so you buy it for $22, and then 18 months you get $25, government guaranteed, and so on the way, like that. So that's why they have that. So one thing about zero coupon bonds, like the slide here is, we mentioned that, right? Reinvestment risk, right? That's the risk that if you have bonds that pay coupon payments, every payment you receive, you got to put it back to work, reinvest it. But if interest rates have gone down, you won't get the same rate of return as before. Zero coupon bonds don't have reinvestment risk because there's no payments coming in the meanwhile. They don't pay until maturity date. Okay. By the way, strips, if they ever, I doubt they'll ask you, but it stands for Separate Trading of Registered Interest in Principal Securities. You probably won't ask that on a test question, but boy, you'll sound impressive if you can remember what STRIP stands for. All right, TIPS, Treasury Inflation Protected Securities. So these give protection against inflation risk. The way they do that is every 6 months, the principal amount is adjusted by the Consumer Price Index. See, the CPI is the standard way of measuring inflation. So it starts off with a $1,000 par value, but then every 6 months it gets adjusted, reflecting the inflation rate. So what will happen is the principal amount will be adjusted by the inflation rate as measured by the CPI. So let's say, for example, it was a 2% inflation rate. 2% inflation. Hang on real quick. Okay, yeah, 2% inflation. So you take your $1,000 par bond, okay, and what's 2% of that? Times 0.02, of course, would be $20. So the principal amount will be adjusted by $20. So therefore, the new principal amount would be $1,020. If the bond matured right now, the bondholder is going to get a check for $1,020, not $1,000, and that compensates for the 2% inflation rate. Now, while the interest rate stays the same, it's the same percentage, but now the bondholder is getting interest on $1,020, not $1,000. So every interest payment they collect is going to go up by a few cents, also covering and compensating for the 2% inflation rate. So therefore, right, this it greatly reduces, if not eliminates, inflation or purchasing power risk. Now, what happens if there's deflation? It can happen. Prices go down. Well, in that case, the face amount of the bond will go down too. Okay, so it will go down from its high point down to something else. But when it matures, as they'll always get $1,000 on maturity. So never less than $1,000. Because it gives you this inflation protection, there is a trade-off, and the trade-off is it has a lower interest rate or a lower coupon, even lower than Treasury bonds did already, and they're really low. So they're even, and if inflation does not end up being an issue, well, then investors are just going to get basically a really crummy rate of return, a really low interest rate, and didn't really need the inflation protection. Okay. All right. The government agencies. Now remember, these are not the Treasury Department. They're government bodies or government entities that do certain government functions, and some of them offer bonds to investors to finance their operations. The Federal Farm Credit System, for example, provides financing to farmers, right, with low interest rates they can have, and they issue these different bonds so that investors can basically get interest from them. The ones they're going to mention for the test, though, I expect, though, is going to be the mortgage-backed securities. The government agencies. There's the federal home loan banks, but the ones I always see come up are I'm going to start with this one in the middle first. The Government National Mortgage Association, GNMA. So since it sounds like GNMA, it sounds like Ginnie Mae for short. Then there's the Federal National Mortgage Association, FNMA or Fannie Mae for short. And the Federal Home Loan Mortgage Corporation, I don't know what it is. It's not that. It's FHLMC. FHLMC. Okay. Federal Home Loan Mortgage Corporation, or Freddie Mac for short. I can see how they got the Mac from the MC. I do not know how they got Freddie out of FHL. Someone figured that out, though. Okay. All right. So what these do, right? They are mortgage backed, which means that all these agencies, they buy mortgages from banks. So a bank creates a mortgage for someone to buy a house. The bank then sells a mortgage to one of these agencies. That way the bank has more cash and can create more mortgage and collect more mortgage origination fees. The bank then takes the agency, like GNMA, takes all the mortgages that they bought, rebundles them, and sells them to investors in what they're called pass-through certificates, which means that when homeowners make their mortgage payments, right, the interest and principal payments pass through to an investor. So investors receive regular monthly income. So especially, by the way, the test question says someone's looking for monthly income. Yeah, I'm looking at one of these mortgage-backed agency securities. That's the first thing I would think of. All right, their minimum $25,000. They have these higher minimums to them partly because these get a little more complicated. And they've got additional risk to them that not everybody quite clearly understands. So they're kind of figuring if someone's got more money, they're hopefully a little more sophisticated. One of the risks they have, now they don't have the default risk, right? GNMA is implicitly guaranteed by the government. But they are subject, like all bonds, to interest rate risk, to inflation risk. But one that's unique to them is called prepayment risk. Right? And prepayment risk happens when homeowners refinance their mortgages early, right? Especially if interest rates go down. Homeowners might refinance their mortgages, take out a new mortgage, and use the money to pay off the old mortgage with a higher interest rate. Well, whoever bought that mortgage is going to get their money back, right? They're going to get its mortgage is being paid off, and they get their principal amount back. Well, now they got their money back, they've got to reinvest it someplace else. And if interest rates have gone down, and again, that's likely what's happened, they'll have to reinvest it at a lower interest rate, right? So they won't get as much income. That's called prepayment risk. It sounds a lot like call risk, except it's just more precise, more specific to a mortgage-backed security. Okay. All right. That is called prepayment risk. There is another one here called the Student Loan Marketing Association, SLMA, or Sallie Mae for short, which basically buys student loans, and then investors can purchase them and get payments when people repay their student loans. Some of you may be familiar with Sallie, maybe more than you'd like to be. Okay, let's check this out here. Okay, in trading government bonds or agency bonds, they're traded, again, the over-the-counter market, which means they're not on an exchange. The over-the-counter market is a dealer market. So there are competing dealers in these securities, that basically offer, they'll say they'll buy it from you at one price and they'll sell it to you for a different price. Okay, right. So as dealers and securities, and they compete, by the way, right? So you can shop around the price and find the best price from one of these dealers. All right. When we have the chance to talk about economics, we'll talk about open market operations, which is what the Federal Reserve does as part of their managing the money supply and controlling interest rates, is with repurchase agreements and reverse repurchase agreements. In a repurchase agreement, we'll go into this in more detail, but basically the federal security government, the Federal Reserve, I should say, buys treasury bonds from banks. So since they buy these treasuries from banks, now the bank has more cash. Since the bank has more cash, it has more money available to lend to businesses. And since they have more cash on hand, well, that increases their supply of money, and therefore that would cause the cost of money, which is interest rates, to go down. All right. When the Federal Reserve wants to slow down the economy and tighten interest rates, they will sell treasury bonds to banks. So the banks buy these treasury bonds. Now the bank pays out cash. The bank has less cash available to lend to businesses. And since their supply of cash has just been reduced, okay, there's less money available, and that causes the cost of money, which is interest rates, to go up. Okay, so that's the open market operations. So with these repurchase and reverse repurchase agreements. All right. Okay. The settlement periods, again, we've kind of covered these, but almost everything is a 2 business day settlement. Trade date plus 2 business days. The exception being treasury securities, government bonds, they are a 1 business day settlement, T plus 1. Okay. Now, what about the tax on government bonds and agency bonds? All right. The rule is, and this will hold up here, is that one level of government does not tax another level. Treasury bonds are issued by the federal government. So the interest income is taxable on your federal income tax, but exempt on state and local taxes. So Arizona is a place where you pay state income tax. Well, you don't have to pay state income tax on government bond interest. Now, bonds issued by government agencies, okay, the mortgage-backed securities, think of it this way. They're taxed the same way that corporations are. See, after all, they buy bonds, they buy mortgages from banks. Banks are corporations. And since they buy and corporate bonds are taxed as ordinary income, no special tax treatment, fully taxable on both state and local levels. So since the source of the money comes from mortgages, therefore the tax is just like it is for corporations, fully taxable on federal and state levels. Okay, well with that brings us to the end of section 4, or chapter 4. This also, we're just a little bit past the top of the hour. So also a fine time to take a well-deserved break. So let's go ahead and break again. And return at, 15 past the hour. As always, if you're during the break, if you have another question, if you'd like me to go back to another slide, please enter your request in the chat on the control panel, or unmute and make your question, post your question verbally, and I will respond appropriately. Okay. Actually, come to think of it, I'm looking at the here it is. I was just looking for the chat function. There it is, found it. Okay. All right. We'll see you in just a few minutes. Okay, welcome back from break. All right, picking up where we left off here. So we're talking about the tax status. All right, so let's go. This covers the parts about government bonds and about agency bonds. Our next section is about municipal bonds, which also includes money market securities too. Okay, so we're going to go through it. So municipal bonds, municipalities refers to state and local governments. Basically this, if it's not the federal government and it's not a government agency, it's a municipality. That means states, counties, cities and townships, but it can also include like authorities, like a school district, transportation authority, a transit authority, port authority, anything else that needs to raise capital to build projects or whatever it is, borrows money from investors and promises to pay them back plus interest. So here we'll talk about the difference of municipal bonds. So starting here with municipal debt. Okay, so as municipal bonds, so first off, municipal bonds, as it says here, just like government bonds are exempt from federal registration. They're not required to register with the SEC. Corporate bonds are. Remember the purpose of registering securities. Why do securities need to be registered? The purpose ultimately is to protect investors from fraud. To protect investors from fraud, they have to know who's out there. Well, they already know who the government is, and they don't know who state and local governments are, so they're exempt from having to register. The major regulator that oversees the municipal bond industry is known as the Municipal Securities Rulemaking Board, MSRB. Now, the rulemaking board, they have authority over companies that sell municipal securities or provide advice or consulting to them. Okay, they do not have any authority over municipalities. It says no authority over like state or local governments, but companies that provide services to or sell municipal securities projects. Now, remember, since these securities are exempt from SEC registration, they are also exempt from having a prospectus. Right, the prospectus is a legal document that gives potential investors everything they need to know about an investment. They don't have that. They're not required to have a prospectus. Instead of a prospectus, they have an official statement, which does the job of a prospectus in providing potential investors with full and fair disclosure of all material facts. Right? That is known as their disclosure document. It's called an official statement. Another thing that a municipal bond needs, well, I should say, it doesn't actually have to have one, but investors will insist upon it, is the legal opinion. The legal opinion comes from the bond counsel. Now, the bond counsel are the lawyers who work for the municipal government, right? Whether it's a city council or a state legislature or a county. Yeah, so they're the lawyers for them, and they're going to give their opinion as to the legal validity of these municipal bonds. Now, investors want to see that because why do people buy municipal bonds? Because the interest income is exempt from federal income tax. So before they plunk their money down, they'd like to know that, as sure as they can be, that they are in fact municipal bonds that are exempt from under IRS rules. So the bond counsel will say, we're lawyers, we know this stuff, and in our legal opinion, this is a municipal bond that counts as having tax exempt status. What we want to see from them is their unqualified opinion. Unqualified means that they don't have any issues, any problems, no qualifications about this bond. No problems with it. Everything's all good to go. What we don't want to see is a qualified legal opinion. A qualified legal opinion means that they've qualified it and says, we've got a problem with this potential bond here. Something's either legal or tax issue does not seem right. So that's what we want. I know we hear the word qualified or unqualified, and we might be tempted to think if they're qualified to give a legal opinion. Okay, no, they're qualified. They're lawyers. They've been to law school and everything. No, it's not the lawyers who are qualified. It's their opinion that has some qualifications. It means some reservations, some problems that they found. We want to see an unqualified opinion. All right, so again, the big deal about municipal bonds is the interest payments. The interest is exempt from federal tax because municipal bonds issued by state and local governments, and one level of government does not tax another. So the interest income is taxable on state and local levels, but exempt from federal tax. That's federal tax free, which is very attractive to investors, especially if they're in a high tax bracket. Because they're in a high tax bracket, normally they have to pay a high percent in taxes on the interest from bonds. But with municipal bonds being federal tax exempt, they don't have to pay interest on it. Okay, now, while they're taxable on state and local levels, but here's the deal. There's an exception to this rule, and it's an important one. Okay, and the exception is if an investor who's a resident of a particular state purchases bonds from their own state of residence. All right, so if we're Arizona residents, if we buy municipal bonds issued in the state of Arizona, then the interest income is both federal and state tax exempt, double tax exempt. So whether that's state of Arizona bonds, Maricopa County bonds, city of Phoenix bonds, okay, Mojave County bonds, city of Yuma school district bonds, all of them would be double tax exempt as Arizona residents. Another big exception are territorial bonds issued by U.S. territories like Puerto Rico, Guam, U.S. Virgin Islands, Marshall Islands. If you buy them from a U.S. territory, the interest income is always federal, state, and local tax exempt. That what I mean by triple tax, right? Local tax exempt. Some areas, some cities have a local tax, like New York City. If a New York City resident buys New York bonds, then the interest income is triple tax exempt from federal, state, and local. So yeah, when you're buying munis, it pays to shop local. Okay, now it does mention here though, capital gains are taxable. Capital gains are trading profits. So if you buy a muni bond and you sell it for more than you paid for it, your profits are still subject to a capital gains tax, which can be taxed at a lower rate, by the way, if you hold it for more than a year. Municipal bonds are going to be put into two major categories. Remember, we draw finer distinctions as we go. So the first distinction is whether they're general obligation bonds or revenue bonds. And that has to do with where do they get the money to repay the bond's interest, principal plus interest. General obligation bonds are GO bonds. Why do they call them GO bonds? Because you go to the taxpayer. General obligation sounds like everybody's responsibility, because it is. These bonds are repaid by taxes, as again backed by the faith, credit, and taxing power of the municipality. Whatever type of taxing power, whatever type of tax that they have the authority to collect. State governments tend to be income taxes. I know it's not true for all states. Counties tend to be property taxes. City governments tend to be sales tax or use tax or transaction privilege tax or whatever they collect out of parking meters. Good. Okay, those are often known as what are called ad valorem taxes. Ad valorem is a Latin phrase meaning according to value. So the property tax, right, is based on the assessed value of a property. Not market value, but it's tax assessed value. Now, since people have to, right, who's going to pay these taxes, they usually require voter approval. So on the last election ballot, for example, there was probably a couple of, let's say, school bond offers, for example, or school bond taxes that they wanted to do. So voters had to approve it because, after all, who's going to pay those taxes? Many places also have constitutional or statutory debt limits, a certain debt ceiling. And if they were going to exceed that debt limit, well, also voter approval is required. There's a special category of a capital appreciation bond, which are a zero coupon bond. That means no make regular interest payments. They don't pay anything until, right, they're purchased at a discount and mature at their face value. Now, the other major category are revenue bonds. The way with revenue bonds, they get the money to repay those bonds by the revenue that the project generates. So if you have to pay a toll to drive over a bridge, you're helping to repay the interest and principal on the revenue bonds that were used to raise that money to build that bridge, right? Or maybe public parking, or expansion of an airport or something like that. Sometimes the question goes, if what type of project is more likely to be funded by a general obligation bond or revenue bond? Well, just ask, does that project generate money? Okay, is it a revenue producing activity? If it is, like toll roads, sewers, right, airports, all these things, right, most likely to pay, most likely to be revenue bonds. Okay, I heard a ding. Did somebody just like raise their hand or something? Because I don't see it here. Okay, well, all right, somebody did. Okay. All right, now, since these bonds, right, these are self-supporting, right? They're self-sustaining, right? They're supposed to pay for themselves. So therefore, it doesn't require voter approval because it doesn't require taxes. They do, however, require a feasibility study. So they got to bring in a consultant to check it out and look to see how likely is it that this project will in fact sustain itself. Will it pay itself off? Right? If you want to pay a toll to drive over a bridge, are there alternatives to driving over a bridge? Right? Are people willing to pay to drive over that bridge? Okay. Anything else that might need, right? So they have to do a feasibility study to ensure, as best as possible, that it will in fact be self-sustaining. So, since they're not backed by taxes, they're backed by user fees, there is that potential, of course, for a default risk if they don't collect the fees that they expected to, or the expenses are higher than they anticipated. So they're going to have a greater risk to them, and therefore, of course, a revenue bond will have a somewhat higher interest rate than a general obligation bond. GO bonds are generally considered very safe because, if necessary, the municipality can exercise its taxing authority to ensure the bonds don't go into default. All right, some things are called these special tax bonds. Some other tax other than property or ad valorem taxes, alcohol, gas, tobacco, for example. They call them sin taxes sometimes, like it says here. Okay, a special assessment bond. Now that might be, for example, in a place where only going to be used to finance, let's say, a project in a particular area, and the only one who benefits from that are people in that area. Let's say maybe like in the old historic part of the city, right? The sidewalks are all crumbling and cracked and need to be basically torn up and replaced. Well, that's going to cost some money, but they figure only the people in that neighborhood are really going to benefit from that. So they might do a special assessment only on the homes in that particular neighborhood. Oh, question here. Can large projects use multiple form of bonds to finance like an arena? Oh, they certainly can, yes. Okay, right. It is certainly possible for them to do that. If it's an arena, for example, all right, those will again, that would probably be a revenue bond. And I'll also go maybe into other details more about that kind of thing as we go. Okay. Okay. All right. A moral obligation bond. Now, this is the case where the bond is a revenue bond, but what if the revenue is not enough to cover? Well, in that case, the municipality could go, let's say, to the state legislature and ask the state legislature, could you pretty please use financing here, use maybe tax financing to repay the bonds because they're about to go into default. There's a moral obligation to do so. They would agree to do so because it's the right thing to do, but there's no legal obligation to do so. In fact, the state legislature can say, we've got our own problems. So, so the answer is no. All right. A double barrel bond is also similar, but all right, double barrel, right? That means shoot them with both barrels. That's a bond that's paid by the revenue that it generates. But if the revenue is not enough to cover it, then the shortfall will be paid by taxes. And now there's a legal obligation to raise the taxes to repay those bonds. So therefore, they're actually defined as general obligation bonds because if necessary, they'll have to raise taxes to repay the bonds. I imagine it's something like a hospital, like a county hospital. Right? Hospitals generate a lot of revenue, but they got a lot of expenses too. And in case the revenue is not enough to cover, then they can say, well, we can't be without a hospital, so we'll make this as a double barrel bond, so we'll raise taxes if necessary if the revenue payments are not enough. Okay, the difference here, double barrel bond, obligated, legal responsibility to pay with taxes. Moral obligation bond, no legal obligation to do so. Certificate of participation is used to build like facilities. All right, they mention a few here like dorms and prisons and office buildings and stuff. And then they lease the facilities to users, and they lease payments based on these from this appropriation here. So again, they're not legally obligated to make the appropriation. It's not officially a general obligation bond. It is a type of a revenue bond. Okay, lease rental bond also used to finance construction, but it's used for basically the city or county government. So city hall, for example, or government offices, they might use this lease rental bond. The rents are paid by the revenue, but the municipality is obligated to appropriate funds for the lease payments from general tax revenues. Okay, quick slide at slide number 99. This one here. Okay, all good, Jason? Sure thing. Okay. This is one we want to talk about, though, is the Industrial Development Revenue Bond, or IDR. Okay. This is a bond. Oh, sorry, did someone have a question? Okay, just checking. Right. Industrial Development Revenue Bond, or IDR. Thank you. So this is a revenue bond that's used for facilities, but it's not used for public use. It's used for private activity, which means business activity. A city might decide they need to attract more businesses or certain kinds of businesses. Right? So maybe they'll create a technology center or something like that. Or maybe there's a neighborhood. There's no grocery stores in the neighborhood. So they might issue an industrial development revenue bond, use that money to finance construction of an office park or a technology center or a strip mall, and make it all turnkey ready for businesses to move into. So then they'll lease space to corporations that will take up residence in that facility. And that's what they'll use to repay those bonds. Here's the thing, though, with the industrial development bonds. Jason, if you can mute yourself real quick. Okay? So because this is public money, but it's used for private use, for business use, the interest income from that can be subject to federal tax based on the alternative minimum tax, or AMT. I'm going to need a moment because we're about to run out of our time here. Okay, and welcome to the next part here. All right, so the Industrial Development Revenue Bond can be subject to federal tax under the alternative minimum tax, or AMT. So sometimes they're even called AMT bonds. Okay. Most of us have not heard of the alternative minimum tax because it does not apply to most of us. AMT was developed in the 1960s when it was noticed that many people in this country with very high incomes paid little, if anything, in income tax because they took every deduction and every loophole and everything. And said, no, this isn't right. Everyone's got to pay some tax. So a second tax system is put into place. So they actually have to do their taxes twice, once the regular way, once the alternative minimum way. And whichever one says is their greater tax, well, that becomes their actual tax burden. Under the AMT, some things that are normally deductible are no longer deductible, and some things that are normally tax exempt, like the interest income from industrial development revenue bonds, are no longer exempt. So just be a little bit cautious in saying that the municipal bond interest is always federal tax exempt. It usually is, except for industrial development revenue bonds, and for those people who are subject to the alternative minimum tax. Sometimes they're also called private activity bonds, or PABs. So again, these are, since they're private activity, that's public money for private use, they're also considered federal tax, right? Also potentially subject to federal income tax. A question is, what is the threshold for AMT? Fortunately, you do not have to know this for this test. I don't even know what it is because I know I'm nowhere even close to it. One thing though, see, is it's never been inflation adjusted. So it was like starting in the 1960s. Well, if someone made, a $250,000 in the 1960s, that was a lot of money, right? Now it's certainly a fair, decent amount of money, but nothing like it was in the 1960s. Okay, so more people end up being subject to AMT than they do before. Remember, keep in mind, right, for the test, when he talks about taxation and stuff, we just got to focus on what they ask about. All right, we're not here, right? We're not taking the CPA exam. So as much as you might be curious to like dive deeper into tax code and stuff, hold off until actually pass the test. All right. Now, municipalities, what they have, when they need their long-term financing, right, they issue municipal bonds. But sometimes in the meanwhile, they need short-term financing. Corporations use commercial paper for their short-term financing, right, whenever they need money for just a little bit. Well, municipalities, they need money in the short term too. For example, all right, if they're raising money by taxes, well, you only pay your income tax on April 15th. All right, so in the meanwhile, these municipal governments need funding and financing to keep on going. So what they do is they create what are called anticipation notes. They're short-term bonds. Short-term usually means like 3 months to 3 years. And they say they pull them forward because they're going to wait for, basically borrowing some money now short-term, waiting for other money in anticipation of other money coming in later. As an example here, they mention bond anticipation notes. So they're going to do a bond offering and raise however much money they need from the bonds. But it takes time to put together a bond offering, put together an official statement, get the word out, get people to buy from them. This is going to take some time. In the meanwhile, they issue bond anticipation notes, right, for their financing in the meanwhile. Then when the bond issue is complete and they get the money from that, they'll use that money to pay off the bond anticipation notes, the BANs. Construction loan notes for like multifamily housing projects. So in the meanwhile, while this house is being built, okay, and there's no revenue coming in from it yet, they'll issue these construction loan notes to pay for the cost of construction stuff. And then when the money starts pouring in, that's when they'll use that to pay off the CLNs, construction loan notes. Tax anticipation notes, like I said, income tax is only collected once a year. Property tax is really twice a year. In the meanwhile, you still need some revenue. So tax anticipation notes, revenue, right, to collect revenue to raise capital in the short term, and when the tax revenue comes pouring in, that's when they'll pay off these TANs. Or revenue anticipation notes, RANs, when they're expecting basically revenue to come in. It mentions here like payments from like state and from like federal government that basically subsidizes things like public transit. Well, in the meanwhile, they still need some financing, so revenue anticipation notes, and they'll pay that off when the revenue starts coming in. Then, of course, you have that combination, which are tax and revenue anticipation notes, or TRANS. If they're expecting federal grant money, in the meanwhile, they'll issue grant anticipation notes, or GANs. Tax-exempt commercial paper, also like regular commercial paper, 270 days or less, but it's basically they have a line of credit with a commercial bank. So since it's backed up by a bank, but still ultimately paid by taxes, these are, of course, our interest, right, the tax-free commercial paper. The variable rate demand notes, or variable rate demand obligations, VRDN, VRDO. Most bonds we've talked about have a fixed locked-in interest rate, right? Pays a certain amount for the life of the bond. Some bonds, however, have a variable or adjustable or floating interest rate. The interest rate changes based on market conditions. They'll usually tie it to something like, let's say, like treasury bonds, for example. So if treasury bond interest rates are going up, then these variable rate demand obligations, they'll start going up too. And investors are going to receive more money every interest payment. On the other hand, if treasury rates start going down, then the interest rate on the VRDOs, they'll start going down too. Okay. Now, what if the investor says, well, they're going down so low, I don't want it anymore? That's why they call them demand obligations, because these bonds are puttable bonds with a put feature, and the investor can demand their money back from the issuer. Give them the bond back, redeem the bond with them, and get their $1,000 back and go invest it someplace else. All right, so they have an interest. They have basically an interest rate is reset periodically, step up or step down. How often? It might just depend, right? It could be on a weekly basis. It could be on a monthly basis. They'll just decide on it. Okay. All right. Trading on municipal bonds. Okay. Muni debt is issued book entry. All right. That means, again, there's no paper certificate. It's all recorded electronically, and is traded in the over-the-counter market, which is the dealer market. So as dealers and securities, they'll offer to buy from you at this price and sell it to you for that price. Now remember, there is a thin market for trading munis. They're not very actively traded. First off, municipal bond investors do tend to be buy and hold, so they don't do much trading to start with. And even when they do, there's just not a lot of active marketplace for them, because first off, if you wanted to sell your New Jersey bond, who's going to want to buy it from you? Probably only a New Jersey resident. You've already got a limited market. And what do you got places that are like very small places, right? Small towns, for example. Okay, like up in northern Arizona, right? There's this town called Rye, Arizona. Ever seen it? You probably didn't, because the sign that says you are entering Rye and you are leaving Rye are on the same post. Okay, that's how. Okay, so anyway, municipal bonds issued by Rye, Arizona, right? Probably a very small market for them. So it may be difficult, maybe illiquid investments. All right, so here again is a summary about taxes on the interest that bonds pay. So as it says here, government bonds, subject to federal tax, exempt from state tax. Government agency bonds, okay, government agency bonds, if they're not mortgage-backed, right, they're also subject to federal tax and exempt from state tax. As they say, privatized government agency. Now, that's like FNMA and FHLMC. Those are corporations that work under government contract. Those are federal taxable. Remember, the source of that money comes from mortgages. Mortgages are issued by banks, and banks are corporations, so they're taxed the same way corporate bonds are, both subject to federal and state tax. There's no special tax treatment on corporate bonds. Municipal bonds, since they're issued by state and local governments, are exempt from federal income tax, but taxable on your state and local taxes. However, the exception is, it's not universally true. I think I've heard Pennsylvania is an exception, but we don't have to worry about that for the test. What we need to worry for the test is if an investor who's a resident of a state buys the municipal bonds from their own state of residence, the interest is both federal and state tax exempt, double tax exempt. And if they have a local tax where they are, triple tax exempt. Again, also territorial bonds from like Puerto Rico, Guam, and Virgin Islands, triple tax exempt. So there's a certain advantage to them. All right, and that not only brings us to a quarter to the hour, but that also ends this section. So I think our timing has been perfect. All right. So let's come back. Tune in Wednesday. Same bat time, same bat channel. All right. Thanks again for being here, everybody. All right. Now check in. Okay. I'm going to start kicking into grades here pretty soon. So if you haven't had a chance, you got to start digging into the material and you got to start taking practice questions. So follow the results in the syllabus, but go even deeper. The way to pass this test is take lots and lots and lots and lots of practice questions. My best advice to you is to make sure you do something on a daily basis. Read material and take practice questions daily. Where it's an hour a day, 2 hours a day. Remember, this is an accelerated course. So you got to spend some time on a daily basis. Keep the momentum going. That will make it the easiest you can for you. So make sure, if you haven't done so yet, now's the time. So get in there, log into the past perfect material, and start taking practice questions over and over and over and over. If you get some wrong answers, that's all right, because you're going to learn the material that way. Okay, bit by bit, you pick it up. Or if you got an answer wrong, well, you'll read the explanation and you'll figure out why it was wrong and what the right answer was, and you'll start learning the material that way. You pick it up bit by bit that way. That's what happened when I took my test. All right, before we wrap up, is there anything that has any questions about it? Anything that's just need a little more detail, a little more clarity about the stuff? Yes, please. Oh, 56. Okay, it's way back here.
Oh yes. Can I get a quick look at slide 56?
Okay, there we go. Okay, so yeah, grab screenshots if you like. We'll have the recording of this. I'll have
All
that
right, and
by the way, have you had a chance? Have you gone to the 99? 99.
Sorry to say it. Sorry to ask again. How about slide 99? I didn't get it. 99.
Okay, there we go. 99. Okay, sure thing. Okay.
I think you.
By the way, I did publish the first video to YouTube on our private SEC channel. Has anybody had a chance to see it? No one? Amy, his thumbs down? Oh no. Karina, not quite? I don't know how not quite is. I think that I have not had time. All right. Anyway, it's still available to you, so it's going to be a resource. This one I'm going to upload. Let the videos render, and I'll upload them as soon as I can. Okay. All right. Any other topics there? My pleasure, Karina. Sure thing. Okay. Anyone's got something? Okay. Oh, Kimberly, thank you. Thank you for the applause. Yes, Karina, you have your hand up.
Oh, yeah. For tutoring, I was just wondering how did that work? Like, because we did that survey to say like which days would work for us. Like, is
get on there, log into get into Canvas, and take that survey. Haven't you? I think so.
And what would that? What does that tell us? Like, are they going to go see like a poll?
Listen, if they got a tutor for you, they were getting funding and financing for it. Take advantage of it. Okay, that's so great, because most places you go, if you want to get a tutor, you got to pay for it yourself. And guys, I'm expensive. So they found some sponsorship for it, some funding for it. Grab it. It will help you so much. It will just turn that things that were just not quite clear for you, and it'll just turn into something better. I'm sorry. Okay, as I said, I've mentioned, right? This is an offer for everybody. 15 minutes.
Would you do any tutoring? You
send
personally
me an email or
to
text
us?
message, and you just let me know what's a good time for you. I promise everyone here you get 15 minutes one-on-one.
Okay.
Well, you can certainly do that, and depending on how many people will take me up.
But as of like further than 15, we'd have to go to a tutor, correct?
This week, 15 minutes next week, and so on. All right, sure thing. Jason, I thought I heard you say something.
Yeah. Oh. Okay. Thank you.
Oh, okay. All great. All right. Okay. Well, folks, if that's all good with us, we're done for this evening. We'll see you again
good.
Wednesday. Have a great rest of your day, everybody, and start taking those practice questions. If you haven't yet, get into the material. Do it daily. All right. Have a great day, everybody. Bye-bye.
Certainly.